Every year around the holidays, people ask me two things. Jay, do you think Megan will let you put up an ornament on the tree? And number two, what's the smartest way to handle charitable giving before year end? I usually answer the second question first because, let's be honest, first one is a definite no. Today, we're going to unpack advanced charitable giving strategies that can potentially reduce your taxes, increase your impact, and make your accountant quietly high-five you from across the room. Seems pretty cool. All of this is especially important because the new One Big Beautiful Bill Act, yes, that's actually its name, and no, Congress did not call me for branding advice, has changed the landscape in a meaningful way. So let's dive in. Number one, why charitable giving is having a moment. According to national philanthropic data, Americans gave $593 billion to charity last year. That's billion with a B, which is roughly the same number of lights Megan puts on our Christmas tree. Even more interesting, household net worth is at an all-time high thanks to market growth and rising incomes. And when people start feeling wealthier, they often start feeling more generous, or at the very least, more motivated to avoid taxes. Giving can reduce your taxable income, support causes you genuinely care about, and become part of a long-term legacy strategy. So whether you're giving because you're a genuinely good person, or because the IRS has a special place in your heart, guess what, folks? It all works. So what are the new rules? This year, timing is everything. The One Big Beautiful Bill Act has created new windows for charitable planning and also new hurdles. Let me break this down in English, not government speak. Number one, the standard deduction hurdle just got higher. Starting in 2026, charitable contributions are only deductible above 0.5% of your adjusted gross income. That means your first slice of giving doesn't count unless you're itemizing and you exceed that threshold. So giving $1,000 when you make $200,000, nice gesture, just not deductible. Number two, bunching is back and very effective. So what is bunching? It is stacking multiple years of donations into one tax year to get over the deduction line. Think of it like Costco. You buy in bulk, you get more value. Except here, the value is tax savings and the free samples are emotional satisfaction. Number three, the asset you donate matters more than ever. Smart gifting often means giving appreciated assets, not cash. Why? Because it avoids capital gains, gives you an income tax deduction, pulls the asset out of your estate. If you're sitting on stock or equity comp with big gains, it might be smarter to give shares instead of writing a check. So, what are some of the options or tools of the trade? Well, you got a bunch of them, and each one serves a different purpose depending on how advanced you want to get. Let's hit the greatest hits. Number one, donor advised funds. Think of this like your own family giving account. You contribute today and get the deduction today, then you can donate to charities over time. It's perfect if you want to, one, get a tax deduction this year, time to decide later where the money actually goes, and three, the feeling of being a small-scale philanthropist without buying the fancy blazer just yet. Donor advised funds are also much easier under the new AGI rules, making them increasingly accessible. Number two, qualified charitable distributions. If you're 70 and a half or older, you can spend up to $108,000 directly from your IRA to a charity. That keeps it out of your taxable income and satisfies your RMD. This is the single cleanest charitable move in the playbook. No mess, no fuss, no taxes, just pure efficiency. What about charitable remainder trust? This is the big league strategy. You transfer assets into a trust. It pays you income for life. Whatever's left goes to charity. It avoids capital gains at the trust level, reduces estate taxes, and gives you a deduction. This is not a cocktail party strategy unless you go to very fun cocktail parties. Some more advanced options for large estates or multi-generational planning, you can also look at private foundations, charitable lead trusts, supporting organizations, and pooled income funds. These are the custom-tailored suits of charitable planning. Perfect for the right person, but overkill for others. So how do we integrate this into your financial plan? Well, the most important part of charitable planning isn't the tax deduction, it's alignment. The best outcomes happen when your giving strategy is integrated into your investment plan, your tax plan, your retirement income plan, and your estate strategy. This is where families create legacy. This is also where kids learn that philanthropy isn't just for billionaires with big libraries named after them. It's for real families who want to make an impact. Those conversations with kids, grandkids, and future generations often become the most meaningful part of the entire planning process. So, in closing, if you're planning to give before year end, this is the moment to get strategic. Between the new tax rules and the December 31st deadline, you've got a window, but not a wide one. Charitable giving isn't just generosity, it's strategy. Done right, you can reduce taxes, maximize impact, build a family legacy, and maybe, just maybe, impress your CPA. If you want help structuring a plan that fits your goals, whether that's $1,000 or $100,000 or far more interesting number, reach out to us here at Frame Wealth Partners. Let's make your generosity work smarter.